Hi, good evening, everyone. Thank you so much for your patience and waiting. Let's go ahead and start out with our today's session. So, today we'll be looking at the fractal market theory. More importantly, we'll be looking at technical analysis, and fractal market theory is just one of the topics that you could use in your trading tools to trade to find investment entry points, as well as it will be useful for you to uh, look at the profits and minimize your risk in terms of your risk management. So let's take a look at the fractal theory. Before we get into that, let's just understand what technical analysis is. In simple words, technical analysis uses chart patterns based on previous historical data. The longer the data, the more data points that you have to analyze your future price movement. Now, technical analysis basically, there are two analyses that people do before identifying entry points in the market or identifying opportunities in the market. One is the fundamental analysis, and the other one is technical analysis. Yes, there are a few more other analysis that investors and traders use to identify opportunities in the market. These are two basic foundational analysis that most of the investors, in fact, all of the investors use as well in their strategies. Now, fundamental analysis, to give you an example, is basically, let's say, for example, you want to buy Amazon as your stock. What does fundamental analysis consist? It looks at the uh, fun, uh, previous returns, previous profits that the company has been doing for the last couple of years. So you look at the revenue of the company, you look at the prospect of the company, and then you decide if the company is a good investment for your trading or investment opportunities, and then you invest. So you look at their financials, you look at their prospects, you look at their products, you look at the company's management. This comes under the fundamental analysis. But when it comes to technical analysis, now once you understand Amazon is a very good stock to buy, fundamentally, now you start looking at technical analysis to understand at what price would Amazon be a good price to buy. Probably when you see Amazon drop down by maybe 20%, you would find it to be attractive to buy. But you use technical analysis based on previous historical data to analyze what would be the potential good entry point. At the same time, technical analysis helps you to keep a target on your investments. So if you have invested in Amazon, technical analysis also helps you identify what are the potential growth aspect of the stock and where you could potentially exit, both on the profit as well as the loss, to minimize your risk. Now, coming to fractal market hypothesis, basically, financial markets are fractal in nature. In simple words, it basically repeats. There are repeating patterns. So if you know about fractals, you understand fractals are basically, for example, you look at a snowflake or you look at a certain pattern which has similar patterns within the bigger pattern. So these are known as fractal in nature. So many of the things that we look around are fractal in nature. The geometrical position of that particular object could be repeated through itself, within itself, and I will show you how similar could be seen on the charts. Like the next point says, this self similatory or can be used to identify trading opportunities to manage your risk. The FMH, which is the fractal market hypothesis, can also be used to explain a wide range of market phenomena. For example, it has been used to identify market crashes. It has been used to identify market bubbles because you see a repeating pattern there, and you also identify market volatility. Now, for today's subject, our main important thing, what how can you use fractals in trading? How can you identify, or how can you use these to identify trends and patterns in the market, and identifying reversals. So let's say you have invested in Amazon, and Amazon has gone up by 30% for the year. But is there a possibility that Amazon could stop at 30% and start dropping back down again? Or would it continue its uptrend? Fractals can help you identify those potential reversal points. And of course, very importantly, fractals can also help you identify crucial levels where one could manage the risk in case the stock starts going against you. One important point that I would like to highlight over here is Fractal is just one of the trading tool that you can implement to identify opportunities. It should always be used in conjunction with other tools like moving averages, or you can use Fibonacci ratios, or you can use RSI oscillators to identify and reconfirm these patterns before taking any investment or trading action. Now let's look at one of the trading tool or available tool that is there using fractals. A very simple analysis on this. So fractal, like I told you, are repeating patterns within a pattern. Now we're just looking at a couple of candlesticks over here, and this basic fractal pattern is based on five candlestick pattern. How the fractal is analyzed is if the high preceding two lower candles is high, and the next two candles after that makes a lower high, this particular becomes a bearish fractal, meaning the prices can start dropping here. Similarly, with a bullish fractal, you see two candles that has made lower lows, the third one makes the highest low, and then the next candle after that starts making higher lows, meaning the pattern is indicating a potential reversal back towards the upside in the market. This particular pattern is commonly used a lot to identify or to get a double confirmation before entering into any particular trade. We'll look at a couple of examples how you can use these patterns in your trading or investment decisions. If you'll have any questions, please feel free to start writing in the chat or the Q&A section. I'll be happy to answer all your questions while we go through this course. Now, keeping fractal in mind and the fractal bearish fractal and the bullish fractal pattern in mind, let's look at a few common things that we have to also keep in mind, which is our support and resistance. If you're very new to trading, I will just quickly run through the different types of charting. The most basic one and a more clear picture given on the chart is the line chart. Now you can see this is basically a line chart for 10 minutes on S&P 500. Basically, it takes closing price of each 10 minutes and plots and moves further down. Now on a chart, on a line chart, it's more easier to find fractal patterns. However, I will still get into more details of how to identify these fractal patterns. But you can see always a pattern that keeps repeating itself. And even if you look within this particular pattern, you would find multiple patterns appearing within the pattern, and hence it's known as the fractals. Now, support and resistance using line chart. Very simple to identify using line charts is every time you see a particular price being reached and it drops back from there, and if the same price or the same length of increase and drop consistently happens more than 3 to 4 times, then you identify support and resistance in the market. Resistance being the prices are taking resistance at a certain interval or at a certain price when it drops back down, and at the same time, every time it drops back down by a certain percentage, it tends to bounce back up. So these are quite important as well while using your fractal trading. Now, coming to plotting support and resistance on a chart, like you can see, these are not line charts, these are candlestick patterns. Now, candlesticks, again, to explain if you're very new to trading, each candlestick represents the time that you have chosen. In this case, we have chosen a 5-minute candlestick. A 5-minute candlestick, basically each candle represents over here a 5 minutes, and it also within the each candle you can look at the open, close, high and low. Let's look at one of the candle over here. This red candle over here represents the body, which is the open and the open and close, and the tail or the wick of the candle represents the high or the low. In this particular candle, the body always is either green or red depending on where the price opened. In this candle, the price opened higher and it went as low as this price, and then closed above the lows. So hence it forms the body, open and close, and red candle, because the close is lower than the open price. And in the during the 5-minute time frame, it had actually gone further down as well, and that is what represents the low and the high. Just to give you another example over here, we see a green candle. The market opened, went slightly lower, so you see a very small wick on the lower end. It went up, it made a high, and it closed slightly closer than the high, and hence the body is the open and close. Since the price closed above the open price, it becomes a green candle. These are important as well to keep in mind when we are looking at candlesticks. Now, let's look at the resistance in this particular example. We see the prices moving up towards 4,140, and it drops back down. Again, it bounces back towards 4,140, it drops back down. It does the same thing for the third time. Like I mentioned to you, anything that repeats itself more than two times becomes a more stronger support or resistance. In this case, we understand that every time it has gone back to 4,140, there is a good possibility of it dropping, because the investor psychology or the trader psychology is once it reaches around 4,140, they look at closing their profits. Now, of course, there are days where the breakout happens, and when the breakout happens is where your risk management comes into place, and people also take advantage of the breakout. Once a resistance is broken and it starts trading higher, they expect this to become the support in the future. I will show this on in a couple of examples as well. Now let's look at trend lines. Similar patterns, instead of looking at horizontally, where we saw a sideway market, we look at trending markets. Trending markets also trend to drop back down and start bouncing back up at certain prices on a certain degree. Now, if you look at this particular example over here, we see the market was trending higher. Again, once you draw your line chart, after 2 to 3 points has been formed, you identify a potential entry point going forward on this particular trend line. Similarly, on the resistance side of it, if it's a downtrend, you see every time the market goes high, it makes a lower high and drops back down. It goes back up, makes a lower high, and drops back down. So if you're a short trader, if you're looking at short trading, you can look at taking advantage of a dropping market or a falling market as well. Now, using all those patterns, like I mentioned to you, fractals are patterns within a pattern. But there are there are few basic patterns that you can identify using line charts. These are some of the examples of how patterns form and tends to keep repeating over different time frames and over different instruments as well. And these are very common patterns that technical analysts use to identify entries and exit. Let me explain one or two in these patterns. So this is a symmetrical triangle. So basically the line represents the price movement. Now, if you notice over here, the price made a high and it makes a low. The second high is lower than the previous high, and the second low is previous than the previous low. So hence it starts squeezing out, or probably the price action is getting squeezed to be broken out on the higher end. Most of the time, a symmetrical triangle, which is a bullish continuation, that means the prices actually came from a lower price to a higher price, and then it consolidates on a sideways range before it gives a breakout and continues the upward momentum. So a lot of people wait for these patterns to have a good entry and to get confirmations before they enter using line chart. This is a head and shoulder pattern. Basically, let's look at this. Uh, the pattern over here, the side two triangle, basically these are the line chart price movement, where you see both the sides represent the shoulder, and the mid triangle represents the head. So shoulder, head, shoulder, you get the neckline. So how a head and shoulder pattern is usually traded is every time similar pattern happens and it breaks below the neckline, you can expect the prices to continue moving down as much as the height of the length of the head. I will show you a couple of examples on this. It may look quite peculiar or simple for these patterns to actually form, and it does form on different time frames, and we look at crucial instruments the people trade on and have seen these patterns appearing in those trades. So similarly with each of these patterns, let me show you an example on the ones that we just saw. So basically we are looking right now at a pennant, so a bearish pennant where the prices have dropped and goes into a sideway movement similar to a symmetrical triangle, and once it breaks below that it continues dropping down. Now in this case we are looking at silver, which on a 15-minute time frame, so we see a sharp drop in silver and a sideway movement where once it broke below that, it continues the pattern on the downside. So anyone who's trading a pennant or a bear flag, since it looks like a flag but on the bearish side, would look at entry once it breaks below the triangle, keeps a stop loss above the triangle, and of course your take profit will be the length of this entire drop that you saw on the higher end. Again, we'll look at a couple of these patterns on the live example as well. We have a reversal, a bull flag. Market rallied quite sharply before it consolidated on the downside. So here it's a bull flag. Basically, once this particular range breaks out, you can expect the prices to continue rallying back on the upside. So similarly, your entry will be on the breakout. Once it breaks above this range, is where you look at taking an entry point, stop loss below this particular pattern, and your take profit will be the length of this entire rally. Now coming to the head and shoulder, this is on SPX, which is the top 500 stocks of US. You see a pattern over here. It made a shoulder, went back high, made a head, made a shoulder again. Now at this point in time, of course, it is still in formation. We would not take any action. We would take an action only once this shoulder is not gone above the head, meaning it has given a confirmation that this is potentially forming a head and shoulder pattern. But your entry is only once it breaks the neckline, like we discussed. Once the neckline has been broken, is where you can take a decision to sell. Now, if you're a short seller, you short sell below this. Of course, you keep your stop loss above the shoulder because in case the pattern fails, you would want to exit because the pattern does not exist anymore. And on the downside, you put your take profit uh, in the same length as the head. So the head to the neck was roughly about 11%. Similarly, once you entered below the neckline, you expect 11% on the downside, and we see the market dropped about 11% and bounced back up from there. Now, one more very interesting thing that we can see over here is it has also formed a reverse head and shoulder pattern. All right, and we will see on SPX on 1 month what has happened with the reverse head and shoulder pattern. Whereas if the neckline, which is these 2 points, you can see shoulder one, head, shoulder two, this is the neckline, and once this break, we expect the prices to move up with a stop loss below the shoulder. We look at what is happening in this particular instrument as of today in a short while. Any questions so far? Please feel free to write. One last topic for the day before we dive into the live charts and start looking at the fractals and looking at the line charts to identify these patterns within the patterns is your average true range. Average true range basically is an indicator which helps you measure the market volatility, or in very simple words, what I would say an average true range is, let's say you're trading on gold on a daily chart. You want to understand, if I'm buying gold today and I want to exit gold within the day's time, you need to understand how many dollars gold should move. Of course, now we can go back into history and manually see how many dollars it has moved, but average true range helps us solve that problem. It calculates for you on an average how many dollars gold can move on a single day by using the average true range tool. Here's an example. We are looking at SPX 500 and I'm looking at a monthly time frame. I go to my technicals, I go to studies, and I choose the ATR. Now, as soon as I choose my ATR, it is telling me that SPX on a monthly time frame can move about $340. So I understand, looking at the ATR, that if I have to make an investment decision today on SPX, where are we for the month? Are we down by $300? Are we down by $400? Or are we already up by $300 for the month? Or if I do enter today, how much of returns, or how much can SPX move in my favor or against me using the ATR. Now let's look at a similar one on a smaller time frame as well in the live chart. So we have covered our fractals, we have covered line charts, we have covered patterns, identifying patterns using line chart. Now we have covered ATR. Now let's use all of these indicators in combination to identify any opportunities today on the live chart, while I show you a few couple of examples on the live chart. At the end of the session, if you liked the information that you have received today and you would like to get more such topics, please feel free to write to me directly on the chat, as well as please feel free to give us a review on Google for the webinar that you've attended today. Thank you. I'm just going to be sharing my live screen now for the charts. Hi everyone, let's continue the session. Let's look at all the topics that we had covered. Let's take one of the product. Let's take Apple. Now this is the line chart of Apple. Let's add our fractals into it, the pattern. So in your technicals, you should find fractals. So this by itself will do it for you. But let's for now not use the fractals directly, and let's do it manually so it's more easier for us to understand. Now for fractals, it's always better to look at your candlestick pattern, and let's look at how each of the fractal has is drawn, at the same time how has it performed eventually. Now understanding fractal, what we learned was the previous two candles should not make a new low, and after it makes a new low, the next two candles has to be high. So then this ends up becoming a fractal pattern, right? So I'm just going to mark all the fractal patterns that we can see. In simple, you can always draw your fractals with all the lows and the highs. So this was a low. Let's just dive more deeper into this particular area. You see there was a fractal here that was made, right? Because these two were higher lows. This was the lowest low, but then after the third, you see the prices dropping back lower again, right? So let's move forward. Let's look at the current levels. You see a new high that was made over here. The previous two are the lower two highs, these two lower. Now you're going forward, the other two has to be lower highs as well. Now here you identify that there is a fractal that is in play, and in this case again you can expect the prices to start dropping below. Similarly, on the previous lows, you see these two making higher lows. This made a new low, and the next two candles making higher lows, and your entry point would be on the fourth candle onwards, expecting the prices to move up. Right now, these are basic ways to draw your patterns manually, but how do you identify these patterns is one aspect of it. How to take advantage of it is the other one. Like I mentioned to you while we are doing the theory part of it, all your patterns has to be in conjunction with few other technical indicators for you to have a more favorable outcome on it, and also for you to have a double confirmation. Now let's keep the fractals on the side and let's start analyzing our trends using line chart. Let's look at line chart here. Now it's more easier using line chart for you to draw your support and resistance lines or a trend line. Now it's very evident that Apple has been trending upward, right? So you see Apple has been moving on the upward scale. Now this is your upward trend line, so that means every time you the prices of Apple comes back on this trend line becomes a support. Now that's just one of the indication. Now let's add a moving average to this. So I would use a smaller time frame because I'm looking at a 20 sorry, a daily time frame. I would use a 25 or 28-day moving average. I'm just going to remove the trend line. Now you see your 28-day or 25 would give you similar trend lines on support and resistance. I'm going to go back to my candlestick pattern. Now let's just look at how the pattern has been creating on its own. And now if we need to add our fractals to these patterns, I'm just going to add my fractal. So once you use your fractal on it, every time you see these white dots over here, those are the trend reversal points. So in this case, because we know the trend is on the upside using a trend line as well as a moving average, you would always look at a buying opportunity than a shorting opportunity. Now, when would you buy it? Every time your trend line coincides with your reversal pattern on the fractal. So let's look at once the trend has begun over here. It did not coincide, so probably I would avoid this trade. The second time it came back down, it did not coincide, I would avoid this trade. The third time it gave us a trend reversal and closer to the trend line, probably I would take this particular opportunity. uh, Again we get this was more in line with the moving average, I would take on this opportunity, and so on. Now we understood the entry point of it. More than the entry point of it comes the risk management and where to keep your stop loss and take profit. That is very very crucial because this trend line has been there for quite some time, but there are good chances the trend line would break and start giving a huge drop. Let's look at a couple of examples in the past. This was a good uptrend, but once the trend reversed, you see there was a big downside on the market. And if you did not have a risk management in place, you would be facing a lot of losses if you have a buy position open on in Apple at that point of time. Now let's look at our entries and exits with stop loss and take profit. Now, how do I decide where to keep my take profit and stop loss? Now, it comes down to what time frame I'm looking at. I'm looking at a daily time frame. I need to understand if I'm taking an opportunity on a daily time frame, how many dollars can Apple move in a given day. So this is where we go to our ATR. Now, ATR tells me that Apple on a daily time frame can move roughly about $2.8, right? And let's say I just want to check. It's always best to know how much it moves in a day, how much it moves in a week, and how much it moves in a month to be more to have a more informed decision. On a weekly basis, Apple moves roughly about $6.9 as of today. On a monthly basis, Apple moves roughly about $18 as of today. Now, analyzing for this month, like I mentioned to you, each candle represents the time frame that we are looking at. This particular candle is this month's candle, which is still open because we are still on the 27th of this month. Has moved. So from the open, Apple has moved roughly about $2, right? But overall, Apple has gone as low as this point and has gone as high as this point. So it has moved about $11. So that means out of $18, Apple has already given us a good volatility of $11 for the month. The reason I'm considering this also is because let's say if Apple were down by $18 for the month, right, that would be a very good indication that market could start dropping below, because now once I go back into my daily time frame, you see if Apple had to close or closes, because we still have the month running, closes below this by $18, we know that the market can reverse and could potentially start continuing downside for a period of time. Now, in the meanwhile, because I'm looking at a daily time frame to take a trade on a daily time frame, I can use the same ATR and understand it moves $2.8 a day, moves about $7 a week. And if I had to take a trade on Apple based on the fractal as well as the moving average in conjunction, the last signal that we got to buy was at these levels. So we look at taking an entry at these levels or on the fourth candlestick. So this first, second, third, and fourth candles is where you would buy. Now it becomes more easier for you to plan your take profit, which would be at the resistance, but most importantly, your stop loss. So let's say you did 100 shares of Apple, you would keep a stop loss of $6. Sorry, about $7, because on a weekly time frame it moves about 6.9, which is about $7 down. So you're not keeping your stop loss too close by to your entry point. At the same time, 0.93, yeah. So you're keeping your stop loss quite lower. At the same time, you can have 1:1 risk reward ratio. So that means you can keep your take profit as well as $1 higher. Why am I looking at the weekly time frame to keep my stop loss and take profit? Reason being, whenever you trade on a daily chart, you're more or less looking at a swing trade for you to gain the momentum over the period of next couple of days or 1 or 2 weeks. So in 1 or 2 weeks, you can expect the prices of Apple to move either $7 higher or $7 lower, and hence we looked at the weekly time frame. Now let's do the same similar approach using a very shorter time frame, probably on Nasdaq. Let's look at 5 minute chart. I do not advise anybody to trade on a 5 minute chart. This is just for example's sake because we have a very short time to understand and see how the execution works. I'm just using this for example purpose only. Please do consult your advisors or your relationship managers before making any decisions. These are all just for example. Let's start off with looking at the trend or support and resistance. Now, in this case, we see it has been a good uptrend here. There was a break below, and there is continuation of an uptrend. Okay. Now, let's add our moving average. 25 or 28 or even 50, but on a 5 minute chart a smaller moving average would give you a much more better indication. Now you see there was an uptrend which has broken below, and now it has been trading below this trend line, so you can expect the prices to take resistance at these levels. Now in conjunction with that, we're going to add our, there we go. So here is our fractals. Now we understand this is the first time it has taken resistance. All this while it was taking support. So every time it came back towards your support, you actually took a buy. It broke below the resistance, and we see it took resistance for the first time. It has dropped down below. Now this is the second time it has dropped down. Again, coming back to how a fractal is formed. If it makes a new high, in this case, it has made a new high in conjunction to this. These two were lower highs. The next two were lower highs as well. So this is the highest point. So this forms the reversal or the bearish fractal. Let me just mark this out quickly. Here's your bearish fractal. Two negative candles not higher than the previous high. So that comes your signal. And it is below the moving average indicating a sell. So let's say we take our sell of 10 units at this price. I'm going to go ahead and take the trade. Sorry. Let me make this 1 unit. All right. So as you can see over here, we have taken a short position. So that means if the market drops down, you will gain from it. Now, very important, do not jump into a trade like this. This is just for an example's sake. You always plan your stop loss and take profit and then do the entry. Now let's look at our stop loss and take profit. We go to ATR. So ATR is telling me that every 5 minutes we can expect Nasdaq to move $21. So that's a good amount of volatility. Now, because I'm looking at a 5 minute chart, I would always look at a 30 minute and a hourly chart to understand if I'm taking a trade on a 5 minute chart. I would be expecting my results to come anywhere between next 15 minutes to next 1 hour. So in 1 hour, I see that, let me just cancel this. Okay, that can be there. In 1 hour, I see that Nasdaq can move about $48. So if I'm taking this trade, I will make sure I keep my stop loss of minimum $48 higher, right? Now my take profit could be 48, or it's always best to have 1:2 risk reward ratio. I would keep a take profit of $100 lower. Now let me zoom that in, modify, perfect. So now what you can see is I've taken a trade on a 5 minute chart based on the signal that it is now broken the uptrend and has become a downtrend. Again, did not jump on the first entry, waited for a confirmation, entered on the second entry. Now, since I've used my ATR as my stop loss on a 1 hour chart, you see my stop loss is way above the reversal point. That means if this reversal fails and it goes higher than this, I'm out of the trade, so I'm not risking much. At the same time, for the risk that I've taken, I've kept a take profit down at the lower end. We can see that the prices have traded in this region for quite some time, so that this could be the next potential support where the prices can come, drop, and go back up. Now you can always use fractals on on the 1 hour chart to keep your stop loss and take profit. So in this case, the take profit looks like it is coinciding with the previous support or the resistance levels. So this makes more sense. But more than that, I would always recommend use your ATR to decide your take profit and stop loss, which would make more sense. One more reason why it would make more sense is when you're doing the number of units. Now, let me take another trade on the same entry just to give you an example. Now, I know my stop loss needs to be roughly about $45, let's say $50 higher, and I need to keep my take profit of $100 on the lower end. Now, why ATR helps me over here more than the fractals is, let's say I was doing 1 unit. Now I understand if it goes against me, I lose $50. If it goes in my favor, I make $100. But let's say if I wanted to increase my returns, so I would probably do a 5 unit trade. Now, in this case, your stop loss is still only $50 higher, but your amount is about $250. So, with your ATR, you can always measure using the ATR to identify how many dollars does it have to move against you or in your favor to make your desired returns. Now, the higher the number of units, the more the risk, the more the reward, but your stop loss has not changed its spot. It still remains $50 higher, and the take profit remains $100 lower, irrespective of the quantity that you're taking. Let's say I don't want to take 0.5 units. I want to be very conservative. I do just 0.5 units. Then my loss is going to be $25 and my profit is going to be $50, because the stop loss and take profit was taken using the ATR. And I understand that if it goes beyond $48, the trend could continue. And of course, it has taken 1 full hour to move against me. So there are good chances that the prices can continue moving in the opposite direction. So your takeaway from this is risk reward is very important. You always make sure you keep double the profit of what you're risking. If not, it would not make sense on the trading side of it if you're losing more than how much you're gaining. At the same time, you use your ATR for your take profits and stop losses, so that every time the market does not go in your favor and it goes against you, you know the risk that you're taking on each trade that you're investing in the market. If anybody else has any other questions, please feel free to ask me. We have another 5 minutes to go. If any instruments that you want to look at, we can pretty much look at that. Also, look at something on the investment side of it. Let's say you're looking at Tesla. More than a day trading, you're looking at something to buy and hold for a longer period of time. Sorry. So we have Tesla here. You're looking at on the investment side of it. We see the markets have gone up. It's made a new high, but the next candle for this particular week has made a lower low. Even if the next candle after this makes a lower low, there is good chances that Tesla could drop back down again. But saying that, we can also be ready if Tesla comes on this particular trend line, like I had mentioned to you. Every time it takes support on a trend line, there are good chances it could bounce back and continue moving further. But we'll have to wait for it to bounce back up and following the next two candles, provided that it did not close lower that from these levels, you can take an entry point Similar with the ATR for your take profit stop loss. I'm looking at a weekly time frame, so I would also look at monthly just to understand how many dollars Tesla could move. In a month, Tesla can move about $62. So if I was taking an investment decision on Tesla, provided that I've got all my signals giving buy indication, so that would be around 216. My stop loss would be $60 lower. Okay, that's about 156. And my take profit, of course, would be 100 points, $100 higher from these levels. So in this case, let's say I wanted to invest out of my portfolio of $100,000, I want to invest $10,000 in Tesla. You could look at potentially making $5,500 with a risk of $2,500. You can always reduce your risk by taking smaller exposures. Instead of 10,000, $5,000, you reduce your risk. So in the case it comes down, and if you uh, plan to invest further, you can always buy more at the lower end if your investment objective was to invest $10,000. And so that's what you would do on an investment side of it. I'll just add fractals to this to conclude for the day. Let's add our fractals. Now this fractals is something that I had not used here earlier, but if you can see, it is coinciding well with these levels at 216 on a monthly chart. Let's look at a weekly chart. A weekly chart also has two levels of support at these levels, and your stop loss, of course, is below your trend line as well as the other two fractals here. Take profit is also well coinciding with the other resistance on the upside. So again, these are not fail-proof indicators. You have to do your analysis before entering. You need to look at the support, the resistance. You need to look at multiple technical indicators which you're comfortable with before taking any kind of decisions. More importantly, also please understand, if you're doing an investment, understand the fundamentals of the company and see if the company is going through any sort of negative or a positive scenario before you take a investment decision. I hope this session was useful and helpful to you all. If you all have any queries, please feel free to get in touch with us directly. And if you want us to cover any other further topics, please let us know. Let your sales representative know, or your relationship manager know your request, and we would love to cover those topics in the future as well. Thank you all so much for your time, and look forward to the next sessions with you all. Thank you.